Whirlpool's strategic resilience, thriving in a tariff-driven market. In today's world, the U.S. trade environment has transformed into a fierce arena for global manufacturers, with protectionist policies significantly altering the competitive landscape. Whirlpool Corporation stands out as a prime example of strategic resilience in this context. By centering its manufacturing operations in the United States and utilizing tariffs to shield itself from international competition, Whirlpool has effectively positioned itself to take advantage of the current trade climate. This raises an important question for investors. Can this approach continue to generate long-term value amidst ongoing geopolitical uncertainties? The tariff advantage, a structural edge. Whirlpool's focus on domestic production has been significantly bolstered by U.S. protectionist measures, with a remarkable 80% of its products assembled within the U.S. and 96% of its steel sourced domestically. The company has successfully sidestepped the $15 to $20 per unit cost penalties that competitors like LG and Samsung face due to Section 232 and Section 301 tariffs. These tariffs, which were expanded in 2025 to impose 50% duties on imported steel content, have severely diminished the cost advantages that Asian manufacturers once enjoyed, leading to profit margins dropping below 7% for appliances priced under $500. The financial implications of this strategy are striking. In the first quarter of 2025, Whirlpool's operating margins increased from 4.3% in the same quarter of the previous year to 5.9%, despite experiencing a 19.4% decline in net sales due to asset divestitures. CEO Marc Bitzer has expressed optimism, predicting a scenario where Whirlpool could emerge as a net winner, with EBIT margins potentially increasing by 150 to 200 basis points and profits rising by 20 to 30% by the end of the year. This margin growth, driven by $200 million in cost reductions and strategic pricing initiatives, highlights how tariffs have created a significant structural cost advantage for the company in the industry. Strategic adaptations, emphasizing cost control and geographic expansion. However, Whirlpool's long-term value creation strategy extends beyond just tariffs. The company has adopted a comprehensive approach to enhance its competitive standing. 1. Premium pricing power. Brands such as KitchenAid enjoy strong pricing power, enabling Whirlpool to mitigate margin pressures, while catering to a higher-end market segment. 3. Geographic diversification. Sales in Asia saw a 12% increase in the first quarter of 2025, which helps reduce dependence on the volatility of the U.S. market and capitalizes on the growing demand in emerging economies. 4. Strengthening the balance sheet. Plans to divest its stake in its Indian subsidiary and reduce debt by $700 million in 2025 reflect a commitment to financial stability. These strategic initiatives demonstrate that Whirlpool is not merely reacting to tariffs, but is actively repositioning itself for sustained growth. Risks and potential retaliation. Nevertheless, no strategy is without its risks. A 30% increase in Asian imports prior to the imposition of tariffs has resulted in an inventory surplus, which may delay margin improvements until mid-2025. Furthermore, retaliatory tariffs from Canada and the European Union could disrupt Whirlpool's export markets, which currently account for 15% of its revenue. While the company's focus on domestic production helps mitigate this risk, it remains a pressing concern in the short term. Investor perspectives and insider insights. Investor sentiment is mixed. While firms like BlackRock and Uveen have increased their stakes in Whirlpool, others, such as Fifth Delta, have completely exited their positions. Additionally, insider sales by executives, including Marc Bitzer and CFO James Peters, totaling $1.7 million in shares, suggest a cautious outlook. However, it is essential to interpret these transactions within the broader context. Whirlpool's stock has outperformed the S&P 500 over the past year, indicating confidence in its strategic direction. The long-term outlook. Whirlpool's U.S.-centric manufacturing model serves as a compelling illustration of how protectionist policies can yield lasting advantages. By aligning itself with the political and economic priorities of the U.S. government, the company has secured a competitive edge that is unlikely to diminish. Its capacity to absorb tariff costs, enhance margins, and diversify its geographic reach positions it well to thrive in an environment where Made in America transcends mere branding. It's a strategic necessity. For investors, the critical question is whether Whirlpool can sustain this momentum. The company's target of a 6.8% EBIT margin for 2025, along with its sales guidance of $15.8 billion, indicates a pathway to consistent growth. However, achieving this will depend on effectively managing inventory challenges and navigating geopolitical risks. Final thoughts. Whirlpool's strategic resilience in a tariff-driven market presents a unique opportunity for long-term investors. While the company is not immune to broader economic challenges, its domestic production model, commitment to cost discipline, and proactive trade advocacy lay a solid foundation for value creation. For those willing to embrace the dynamics of U.S. protectionism, Whirlpool stands out as a stock where policy and profit converge. Investment recommendation. Consider including Whirlpool as a core holding in portfolios that seek exposure to the resurgence of U.S. manufacturing. Keep an eye on quarterly margin trends and developments regarding tariffs, and take advantage of valuation dips, such as those following earnings announcements, to accumulate shares. Whirlpool stock crashes, dividend cut, Bank of America downgrade explained. In a surprising turn of events, Whirlpool has faced a downgrade from Bank of America following disappointing financial results and a significant cut to its dividend. This news has sent ripples through the market, raising questions about the company's future and its ability to recover from these setbacks. Whirlpool, a well-known name in the home appliance industry, has been struggling to maintain its previous performance levels. The recent downgrade reflects concerns over its profitability and overall financial health. Investors are particularly alarmed by the decision to reduce dividends, which is often seen as a signal that a company is facing serious challenges. Dividends are typically a way for companies to share profits with their shareholders, and a cut can indicate that the company is not generating enough revenue to sustain its previous payout levels. But here's where it gets controversial. Some analysts argue that this downgrade could be a temporary setback, while others believe it signals deeper issues within the company. For instance, the ongoing supply chain disruptions and rising material costs have posed significant challenges for many manufacturers, including Whirlpool. These external factors could be contributing to the company's struggles, suggesting that the situation might not be entirely within Whirlpool's control. As we delve deeper into this situation, it's essential